There is a silent killer of wealth lurking in the shadows. It creeps in slowly, unnoticed, and before you know it, your money no longer buys what it used to. This dangerous foe of you achieving financial freedom is inflation. But what if I told you that you can protect yourself, and even better, come out ahead in times of inflation? Welcome to the Road to El Dorado, the channel where we help people achieve extraordinary financial results and long-lasting wealth. If you're new here, make sure that you hit the subscribe button so that you can join a community of people who are serious about taking their financial future in their own hands. Now, let's dive in this video. Let's start at the beginning. What exactly is inflation? Inflation is the rate at which the general level of prices for goods and services increases over time. In simple terms, the same amount of money buys for you less than what it used to. You've probably noticed it when your grocery bill goes up, the fuel prices climb, or rent increases. That's inflation in action. So what exactly causes inflation? There are several factors. First, we have what is known as a demand pull inflation. This is when the demand exceeds the supply. Second, we have what is known as a cost push inflation. This is when the cost of production goes up and the business passes those costs down onto the customers. Third, we have the monetary policies driven inflation. This happens when the central banks print too much new money or they keep the interest rates low for too long. All of those forces cause your money to lose value over time. This is why we can't just sit on our cash and hope for the best. We gotta do something. Let's now discuss why inflation is such a big deal. If, let's say, in your bank account you're having $10,000 and we are having an yearly inflation of about 5%, in just 5 years the value of your $10,000 will drop to approximately $7,800. Your money is losing its value simply by sitting still. Inflation silently reduces your purchasing power. It shrinks your savings and it can destroy your long-term plans if you are not prepared. This is why it's crucial for you to find ways to protect yourself from it. Let's now discuss several powerful ways that you can use to keep yourself safe from inflation. We know now what inflation is and why it's a problem. What we need to figure out, however, is how to keep ourselves protected from this financial danger. The good news is that there are multiple different ways that we can keep the value of our money and possibly even grow it while inflation is rampaging. All those ways are related to smart investments. Let's now discuss the best and most proven options. Let's start with something classic. The first investment that can protect you from inflation is real estate. Real estate is one of the best long-term hedges against inflation. Why? Because as inflation rises, so does the value of your property and, more importantly, rents. What this means is that the value of your asset increases while it also generates more cash flow over time. Let's look at the pros of investing in real estate. The first one is that it's tangible and stable. It's a real physical asset and people will always need places to live and work. Second, rental income rises. In many markets, rents are indexed to inflation. This means that your income stream adjusts naturally. And third, leverage works in your favor. You can use borrowed money to buy the property, and actually, inflation will reduce the real value of your debt over time. And here are the cons of investing in real estate. The first one is that it requires significant capital. Down payments, closing costs, taxes, you need money up front. Second, it's not liquid. You can't sell a house overnight if you need quick cash. And third, there is maintenance and some risks. You have to deal with tenants, repairs, and sometimes your property may remain empty for a while. The second investment you can use to protect yourself from inflation are stocks. Stocks represent ownership in companies, and during inflation, companies often raise their prices to much higher costs. This keeps revenues flowing, which helps stock values rise. There are some sectors that even directly benefit from inflation, like energy, consumer staples, and industrials. Here are the pros of investing in stocks. The first one is that historically, stocks beat inflation. In the long term, stock market returns outpace inflation significantly. Second, you get dividend income. Many companies pay dividends, and over time, this can provide a buffer against inflation. And third, they are highly liquid. You can buy and sell stocks whenever you like with just a click of a button. And here are the cons of investing in stocks. The first one is volatility. Stock prices can swing wildly in the short term, especially during economic uncertainty. Second, not all stocks benefit. Tech companies or growth stocks may suffer, especially if inflation leads to higher interest rates. And third, it requires knowledge. Picking the right companies takes time and requires some knowledge. If you don't pick good companies, then you risk underperforming. If picking individual stocks feels too risky, then the third option on our list, ETFs, gives you diversified exposure with far less effort. Some ETFs even focus on protecting your money from inflation, like those that track commodities and other real assets. When it comes down to the pros of investing in ETFs, the first one is that you get instant diversification. You spread your risk across many different companies or sectors. Second, you benefit from low fees. ETFs tend to have very low management costs. And third, you get easy access to inflation-sensitive assets. Certain ETFs hold commodities or real estate, which often perform well during inflation. There are also some cons, of course. The first one is that ETFs are market dependent. They still move with the broader market. The second one is that you have less control. You don't get to handpick individual companies. The third one is that not all ETFs are created equal. Some come with higher management fees, while others will underperform. This is why it's still important for you to do your own research. Now we get to option 4, which historically is one of the best hedges against inflation. This is the gold. Gold has been used as a store of value for centuries. During times of inflation or economic uncertainty, people often turn to it as a safe haven. It doesn't generate income like dividends and trends, but it does protect against currency devaluation very well. When we look at the pros of investing in gold, the first one that we can see is that it is historically reliable. Gold usually retains or gains value when paper currency loses theirs. Second, and very important, it has global acceptance. It's trusted worldwide. And third, it's also a hedge against crisis, not only inflation. Gold can perform very well in times of geopolitical or financial instability. When we look at the cons, the first one that we can see is that there is no cash flow. Gold doesn't pay dividends or interest. Second, there are some storage costs. Physical gold must be stored safely and insured. And third, you need to be ready for short-term volatility. It can swing in price, especially if investor sentiment shifts. Now we get to the fifth option, which is the newest one of them all. This is the crypto market. Some investors view Bitcoin as digital gold, a limited supply asset that can't be printed like fiat currency. During periods of distrust in traditional systems, crypto can attract attention as an alternative store of value. Let's now go over the pros of investing in Bitcoin. The first one is scarcity. Bitcoin has a fixed supply. Only 21 million coins will ever exist. The second one is decentralization. It's not controlled by governments or central banks. And the third one is that it has huge upside potential, especially if adoption continues. When it comes down to the cons, the first one is that Bitcoin has extreme volatility. It can rise or crash dramatically in a very short period of time. The second one is that there is still some regulatory uncertainty. Governments can crack down or change rules at any time. And the third one is that it is still speculative. It hasn't yet proven itself completely as a reliable hedge against inflation. Finally, let's talk about what you shouldn't do in times of inflation. This is holding large quantities of money in cash. If, let's say, in your savings account you're getting 1 or 2% of interest per year, but the yearly inflation is 5%, then you are still losing more than what you are gaining, and essentially you're moving backwards. Having that said, it's extremely important to keep at least some cash, ideally 3 to 6 months worth of expenses as an emergency fund. Beyond that, you might be better off putting your money into assets that can grow in value. Cash is safe short-term but can be toxic long-term if you want to build wealth, especially if inflation levels are high. And here is one bonus from us that can save you from inflation and help you achieve financial freedom. If you want to become wealthy, knowledge is essential. In our channel, we provide exactly this. So make sure that you subscribe so that you don't miss out any of our future videos. We appreciate it. Inflation isn't going anywhere, but you don't have to be afraid of it. Instead, you can use it as a signal, a push to start investing in assets that can protect and grow your money. Real estate, stocks, ETFs, gold, crypto. And remember, do not let your cash sit idle, otherwise inflation will eat it alive. The road to financial freedom is long, but together we are walking it one smart step at a time. Thank you for watching. I'll see you in the next one.